Welcome back. You're watching Stock Watch with me, Zinati Guma. And joining me to take your stock-related questions tonight are Shane Watkins from All Weather Capital and Gary Booysen from Rand Swiss. Be sure to send your questions via email at stockwatch@bdtv.co.za or an SMS to 41392 or an X using the hashtag StockWatch. Thank you so much for your time, gents. There's been quite a lot that is going on as companies wrap up the year. They all are clearly trying to release results and trading statements before the year ends. And actually, really, the big one for today was the listing of Boxer on the JSE. I missed that one, and I must say I have FOMO that I missed it. I had other engagements. Gary, the last time I saw you at the JSE, it was the listing of Altvest. Were you there today?
Of course I was there today, yeah. So watch the first trades go through at 63.01. So the massive bump in the share price from that kind of 54 Rand listing price. So yeah, it was very successful. It was very packed downstairs. A lot of excitement as well, listening to the CEO. I think Boxer's clearly quite excited to be listed separately, although of course Pick n Pay still has a big stake in it. So I wonder how this is going to pan out, because they I suppose are from a brand point of view competitors now, but Pick n Pay still a significant shareholder and still pulling some strings.
All right. And actually, what do you think of the price, Shane? Because obviously we know that the initial with the private placement was 54 Rand, but I think largely people knew that it would actually climb on listing. Do you still think that even though it did surge from the 54 to about 63.01, that is maybe still a good price for Boxer?
So, Zanati, good evening. Yes, I do think it's a good price for Boxer, and for two reasons. If you look at the Pick n Pay group, there's Pick n Pay, which is obviously a value opportunity that we can talk about, and Boxer, which is a growth opportunity. And the thing about Boxer is it's got 500 stores. Management expect that they will double that number in the next 6 years, and they will also improve the like-for-likes in the existing stores. So in my opinion, Boxer should trade on a slight premium to Shoprite, which is already a very highly rated retailer, because it's got slightly superior operating margins and it's got slightly superior growth prospects, mainly because it's a smaller company that hasn't rolled out geographically yet. So, you know, at the current price where it closed today, it's probably around the Shoprite rating. I still think there's upside in Boxer from here. I think it should trade somewhere perhaps between a little bit above Shoprite and a little bit below Clicks.
Okay, quite interesting. Also, the point that you make there that Pick n Pay is more of a value offering, and Boxer is growth. There's a question here. Yeah, because I think a lot of people had also been watching what happens to the Pick n Pay share price. A lot of people thinking that it was going to rally, but it actually didn't. Gary, what do you think of this? Do you think that this is something that should have mechanically happened, or was it just that investors had already baked in everything into Pick n Pay's share price before this?
Yeah, I think there's fairly good price discovery on Pick n Pay. So yeah, and this is well telegraphed to the market, as most listings are. And I mean, we've seen a big run up on Pick n Pay over the last couple of months ahead of the listing. So I think a lot of that priced in. You know, we did get a couple of questions with clients saying, when will I receive my Boxer shares? I'm holding Pick n Pay, and kind of saying this isn't an unbundling. You're not going to receive. But yeah, I suppose still you do hold a stake through Pick n Pay. But yeah, I mean it's interesting. So I mean, Boxer valued at you know even at the 54 Rand handle was around 25 billion. So that's more than Pick n Pay's market cap. So it's fascinating to see. You know, you do get the sense that there is a value opportunity in Pick n Pay. But I think Pick n Pay has just been such a difficult stock to hold for so long. You've been kind of promised the turnaround at Pick n Pay for decades almost. And I mean, maybe with the management team change, Sean Summers back at the helm, maybe we'll see a little bit of progress. I mean, obviously their debt has come down significantly after the 4 billion rights issue, and now the successful IPO of Boxer as well. So I mean, the balance sheet in a lot better position, but you've got to, I suppose, believe in management's vision to make Pick n Pay a premium retailer in South Africa once again.
Well, one person that has believed in management's vision is Shane, and he's right here with us. Shane, you have chosen Pick and Pay on some of the episodes.
Let me talk about it. You're right.
Okay.
I mean, I think largely I agree with Gary. What I would say though is that if you look at Pick and Pay, the market cap of Boxer is 30 billion. Pick and Pay have got 65% of that. So the amount of Boxer embedded in Pick and Pay is 20 billion. Pick and Pay's total market cap is only 22 billion.
Yeah.
So you're paying for Boxer and a very little bit more, and then you're getting the rest of Pick and Pay. And what is that? Well, first of all, I mean, there's 5 billion of net cash.
Yeah.
There's 400 corporate stores. There's 400 franchise stores. There's 22 hypermarkets. There's 350 clothing stores. There's a couple of hundred liquor stores.
Yeah.
And you're getting all of this for free.
Okay.
What management need to do is obviously turn these corporate assets that are severely loss-making into a profitable situation. And I would say that one of the reasons that will help them is that I think the business, up until Sean taking over the company, was so truly appallingly managed that there are actually some easy wins. And I mean, Sean is a talented guy, he's enthusiastic, passionate, and I think he's just doing the basics well. And as I say, you've got to decide whether you think, paying basically nothing for 1,000 stores and net cash of 5 billion is worthwhile or not. And I would say yes. But I do think it's interesting because there's something here for growth investors, Boxer, and something here for value investors, Pick and Pay.
Okay. All right. Fascinating. Let's get on to another retailer. Spar came out with its results today. Its annual results for continuing operations. We did see growth in their financial metrics. Not much movement on the share price today. I'm wondering how investors digested Spar results today. It looks like the numbers didn't look that bad, Gary.
No, they didn't look terrible, but I mean a lot of volatility as well. But I don't know. Some of that volatility also, I suppose, the US is going to be out of the market. I think a lot of people are looking ahead to Black Friday. But if you look at Spar as a group, I mean they've had a very difficult 18-month period. I mean whenever you hear a SAP rollout in a SENS announcement, you almost cringe these days, thinking, what has gone wrong now? But Spar is a very different business from the likes of Boxer, Pick and Pay, and Shoprite and Woolies, in that it's a guild and it's a franchising opportunity. And from our point of view, Spar can't trade on the same multiples as a Pick and Pay or a Shoprite or a Woolworths because it's just a totally different business model. And with the digitization of retail that we've seen in the offshore market and that Shoprite is really bringing to the domestic market as well, that's far more difficult for essentially the franchise model to handle. How do you do a 60/60 delivery service for Shoprite? It's incredibly difficult. Just also franchising is a difficult business in the modern age as well, because every Shoprite owner wants to promote their store, but how many Shoprite Twitter handles are you going to, at least Spar, every Spar owner wants to promote their store, but how many Spar Twitter handles or Instagram pages can you possibly have? So in the digital world, that model doesn't work for us as well as a corporate model like the rest of them.
Yeah, I mean, just talking about this SAP implementation, I did speak to the CEO earlier on, and he actually said, I think in the second half, it didn't affect the sales, it affected the margin, but they've seen improvements after the reporting period. I mean, they've gotten rid of Poland. And I did take a look at I think 1 or 2 lines on the delivery app. And they are seeing some growth, obviously, maybe still little compared to the other retailers. It just seems like they're on a better footing and maybe just laying a foundation for what could be growth in the future. They also said that they've arrested market share declines. Shane, I mean, is this not looking like it could have some legs at this point?
Donati, I've been looking at the retail sector for 30 years, and the benefit of that perspective is the following. From 1994, when we had the elections, until 2010, South African GDP grew 3 to 5%.
Yeah.
From 2010 until 2024, which we sort of characterize as, largely an era impacted by the Zuma government, the economy grew either nothing or less than 1%. The best year of growth I think we had was 0.9. So what I'm getting at is we've had 30 years of kind of democracy. The first 15 was economic growth of 3 to 5, and the next 15 was basically nothing.
Yeah.
Now, what retailers essentially need is economic growth in South Africa. And I think that we are poised for a period of good economic growth for various reasons, including, no load shedding. We haven't had load shedding for, I think, 310 days. Including the government of national unity, which seems to be making more sensible economic decisions, including lower interest rates and so on. So if there is a sector that gives you gearing to better domestic economic outcomes, it's the retail sector. And, when I joined the market in 1995, Foschini traded on a 33 PE. That was because there was growth. The ratings of the retailers imploded because there has been no growth for the last 15 years.
Yeah.
But those ratings can expand and those earnings can expand. And so we feel quite confident about the retailers, and including about Spar, which is partly a self-help story, getting rid of Poland, getting rid of Switzerland, getting the SA margins to 2.5%, and also a bit of a GDP recovery play domestically.
Well, I mean, just you talk about Switzerland. Does it look like they're going to get rid of it? Because I did ask the CEO, and they didn't confirm or deny anything, but it just seems like there are conversations that are being had there. Shane?
I think that, smart management teams that have an asset they want to sell don't tell anyone that they want to sell it until it's sold.
Yeah.
So I think this is part of a strategy, but I have no specific information on this, but the demeanor of management leads me to believe that they will certainly sell Switzerland, and that will be the right thing to do.
Yeah.
They have no real expertise in Switzerland, and Switzerland is a geography where the margins are always going to be compromised. It's an odd situation, but the Swiss drive across the border and shop cheaply in France, and so you just can't make money having a store in Switzerland.
Gents, we are getting more questions, and I want to start off with, this is quite an interesting one. Which two offshore stocks would be your never sell stocks, like never sell? Gary, but can you actually have a phenomenon where you're like, I would never sell this?
Yeah, I was going to say that there's no such thing as a never sell stock. so yeah, I mean, the Warren Buffett philosophy is, yes, you want to go into a stock saying I'm never going to sell this stock, but the fact is that eventually, I think Warren Buffett also uses that farm example. Being listed is like someone coming to your farm and it's a productive asset and they're shouting a price at you. Eventually, the price could be high enough that you just go, this farm's not worth that. Of course, I've got to sell it. So I don't know if there's such a thing as a never sell stock. So I think if you're looking at a never sell product, maybe rather instead, something that I kind of consider that I would never sell is something like the S&P 500 ETF by Vanguard. It's 3 basis point management fee. It's so dirt cheap. You get 500 of the biggest companies in the world. You don't have to sell it because obviously the ETF is reweighting naturally inside it. So you don't have to realize your capital gains. You can literally just sit on this ETF for years and years and years. And I was going to say something like Alphabet. I mean, Alphabet is it's a just with what it's doing in self-driving. I think you've got to have exposure to the big tech. It's something I probably wouldn't sell, but something like an ETF like that. If let's say search disappears completely and Alphabet collapses, it'll just drop out of the ETF and it'll be replaced by the next thing. So for me, it's more about the investment, like an investment product like that. I'd rather probably buy an ETF indefinitely, which is naturally going to mechanistically reweight, than try and pick a company that's going to survive. I mean, the speed of change that we're seeing these days with AI, I think the most profitable companies of the future haven't, even in the near future, haven't been created yet. And I think some of the 100-year-old companies that you think are absolutely unstoppable are going to be going out of business. So I think the market's going to get very interesting in the next 10 years.
I mean, Gary, it's quite interesting that you mentioned Alphabet and the S&P 500, because in my head, as soon as I saw Nevasa, I thought maybe AI, I thought maybe NVIDIA. Shane, would that be crossing your mind or not?
Gary is 100% correct. If you look at Morgan Stanley have looked at data that goes back to the 1970s, and they found that there have been 3 periods where growth has outperformed for a decade and 2 periods where value has outperformed. So, if you had been in the wrong area of the market, you've underperformed for a decade over the last kind of 60 years of data. if you go back about 50 years and you look at the stocks that were in the Dow then, I think there's only one or two of them that are still in the Dow. If you go back further, all of the stocks are, that were there 100 years ago are no longer with us.
Yeah.
And I think the rate of change that we see is actually accelerating more than anything, as Gary said. So I think it's very hard to say what you would be in. I mean, I would say if you'd asked me 6 months ago, I would have said be in the social media stocks because they seem to have strong moats around what they're doing. But I mean, today Australia announced that they're banning all social media access for anyone under the age of 16. And I think it's likely that you will see the big tech companies get regulated. So, then maybe you would have said, well, let's invest in big pharma because the big pharma stocks are clearly going to do well because of AI. But Robert Kennedy has said that the big pharma stocks have been profiteering. The results of some of their trials are fraud, and he wants to go after big pharma. So I think you've got to be nimble in this market because things change quickly.
Yeah. Shane, I want to stick with you because off air you mentioned the Remgrow AGM, and I do believe that there has been an appeal on that rejected deal on Massive and Vodacom
CRVH,
by the tribunal. I do know that the DTIC was in support of the deal. What's happening there? How are you digesting that?
So, Zanotti, great question and super interesting situation. Parks Tau, which is the minister in charge of DTI, he has appealed the decision by the competition authorities who report directly to him. In other words, the political boss is saying to the bureaucrats, I think you have this wrong.
Yeah.
Now, I mean, I think it's pretty evident that the competition authority has this wrong. I mean, to the extent that the competitors to Vodacom, who, should be protected by the competition authorities, also were in support of the deal. So, I think it's interesting that we're getting more sensible economic decisions from the political masters, if I can call it that.
Yes.
And I mean, that obviously is great because the last 15 years where Abraham Patel has been in the Department of Trade and Industries were characterized by very low growth and a lot of mergers turned down for no reason whatsoever, for no rational reason. And, President Ramaphosa has been offshore trying to drum up foreign investors into South Africa. Some of these investors have arrived with their checkbooks. For example, there was a bid for Hulaman, and the competition authorities turned this transaction down. And so, it's almost like within government, the left hand doesn't know what the right hand is doing. The one crowd's trying to bring investors in, and the other crowd is trying to keep the investors out. And so at least Parks Towers now recognize that, likely a decision that is not rational or commercial has been made, and we will see what happens. But, some industries require scale, and putting fiber in the ground is one of those industries. And the thing that CRVH has been doing is putting fiber in the ground in underprivileged areas.
Yeah.
And so there's a huge economic benefit to what they're doing, especially for underprivileged people. And, I have to say it's absolutely lunatic that this merger with Vodacom was turned down.
All right. Well, Gary, I quickly want to go, before we go to your stock picks, to a question here. Comments on the SA listed property index. Is there any value there? And if so, which stocks do you think are worth the buy? I do know that there's an ETF as well. But also, I guess the viewer really wants to know on stock picking, which stocks do you think are worth the buy? I do know that there's been a lot of appetite for the property sector lately.
Yeah, absolutely. And I suppose the show is called Stockwatch, so it's fair enough that he's looking for individual stocks. So the property index has done fairly well. So, I mean, we've been kind of chatting about it on a couple of shows now. I mean, we're moving into, a falling interest rate environment. And, we've just had such a difficult environment in South Africa for so long. And with a little bit of optimism returning, it's very possible that we see a little bit of economic growth, as Shane was saying, that will definitely benefit the retailers. And, retailers also benefit massively in falling falling interest rate environments, and property is similar in that case as well. One of the reasons also is that suddenly you can't get as good a yield in the bond market, but people have a little bit more money in their pocket, rentals become a little bit more secure, and suddenly you have to lift the capital value of the properties. You've got to pay up a little bit. Banks will lend again. So property index is up just under 22% at the moment, but it's a very disparate story. So if you look at the underlying property stocks that make up that index, it's, there's a huge divergence underneath them. So in our portfolios, we love storage. We've held storage for a long time. It's been a great performer. If you look at the share price, if you're just Googling the share price, you're not going to see a huge lift in the share price because obviously there's distributions as well. You've got to look at the total return. So we like it as a speciality REIT. It's obviously, you'll see at least their facilities all over the place. It's that big red branding, and they typically have quite a high margin compared to regular landlords. They also, so we like it. It's done very well. The other one that we hold is kind of more of the larger guy in the sector, which hasn't done particularly well, but I think will improve dramatically, and that's Growthpoint. Okay. I think Growthpoint has a significant chance of re-rating just with a better environment.
Okay. Shane, on your side, would you have an interest in the property sector and maybe favorite picks there?
So Gary has articulated that quite well. I mean, the bottom line about property companies is that for them to do well, their underlying clients need to do well. And mostly the underlying clients of property companies are the large retailers. And we've had 15 years where the retailers haven't done well because the economy hasn't been growing. Now, if you do a regression of where the property sector should trade, the data says that the valuation of which a property company should trade is the government bond yield, say 10%, minus a third of the amount that property company is growing. So like, let's say the property company is growing at 10, a third of that is called a 3, 10% on the bond yield minus 3, property company should trade on a yield of 7. But when there is no growth, they essentially trade at the government bond yield or higher. So the thing that will re-rate the sector is them growing their distributable earnings. And I think as Gary said, I think there's fairly good evidence to suggest that will come as the economy starts to grow.
All right. Well, gents, we have reached the final segment of the show. Your stock picks. Gary, what are you choosing?
Yes, we've kind of had an all retail show today, and so I'm actually going to go with Shoprite as my pick for the evening. And we've held Shoprite in portfolios for a long time. I mean, it's an absolute juggernaut in the sector. I think it's the leader, and there's an economy of scale to these things as well. I mean, if you look at their distribution, and I know Sean likes Pick and Pay, but and I know there's an argument for a turnaround. But if you look at the way that Shoprite manages its intelligence, the way that their DCs work compared to the other retailers, it's just they're leaps and bounds ahead in terms of technology. Obviously taking a bigger stake in the delivery business as well. It really is an incredible operation, getting rid of the house and home to PEP, also just really allowing them to focus on kind of that last mile delivery. And I think it's excellent. Compared to what Shoprite trades on in multiple terms, it's really not expensive historically. Sean was talking about years ago. I mean, I also remember retailers, the foreigners absolutely loved South African retailers. You'd look at the shareholder base and it'd all be foreign. And I mean, they were trading on much higher multiples than they do today. And in a slightly better operating environment, retail sector, I think, is going to run really, really hard. And Shoprite is a great company at a fair price, I think. So something to add.
Well, surprise, surprise, Shane is also going for a retailer and Pick and Pay.
Well, I think we've kind of sort of thrashed the Pick and Pay story out there. I think there's significant upside, but it's a self-help story. Maybe if I can change tack, and since it was the Remgro AGM today, say that I would like to maybe go for Remgro.
Okay.
The reason you like Remgro is they've got great assets and poor management. That's essentially the story. I mean, I'm not talking about the management of the operating companies. I'm talking about at the executive level at Remgro. They've got great investments. They own a big stake in Outsurance, fantastic company. They've got a stake in Discovery, fabulous business, really a global value sharing operation. They have stakes in CIVH, which is the fiber business. They have a stake in Mediclinic. They have a stake in Heineken. They have very, very good assets. The total value per share of Remgro is 300 Rand. But Remgro trades at 150 Rand. And there are two reasons for that. The one is that the underlying operations have underperformed. But the other reason is that management are really unenergized and they haven't really acted in the best interests of shareholders. But I think that there's a sufficient margin of error here, notwithstanding the misgivings I've expressed about management, for it to be a good investment.
All right. Well, thank you so much for your time and for your analysis today, gents. That was really, really fun. That is all for tonight's Stock Watch. Thanks to our guests, Shane Watkins from All Weather Capital and Gary Booysen from Rand Swiss. Up next, the close. Stay tuned.